right, so the grains were kind of able to hold on to gains today. Soybeans unable to buck the trend of lower soy meal. There's lots to talk about. I want to start at the difference between a supply-driven and a demand-driven market. I know it may be elementary for some of y'all, but I, for one, could use a fresh look at the supply and demand balance. Live from a molasses cookie kind of day via Farm Journal broadcast, this is AgriTalk. This afternoon, I will chat with Carl Setzer from Kansas, and directly following the news, Matt Bennett from agmarket.net checks in. I'm in for the sojourning Chip Flory. It's me, your pal, Davis Michelson, behind the big green leafy microphone of AgriTalk. So glad you've opted to join us today. To join me, I'm flying solo today. Chip is headed down to Commodity Classic. He and Big Apple Joe are making their way southward to Houston. We got a rundown from Big Apple himself this morning about where you can find them. I'll hit those sort of as we go along here, if time permits. But man, we got a lot to talk about. I've got Carl Setzer from Kansas on today, and of course, if it needs to be said, we'll hit the markets, what you need to do, old crop marketing, new crop marketing, should have sold more, yada, yada, yada. We'll get to all of that. But Carl and I were going back and forth just a little bit ahead of the show here. And he brought up some excellent points about this market and maybe some reasons why we should be careful not to be too down on these markets. In putting together this month's Landowner, which is almost complete and ready to go out to you good subscribers, I took a look at 3 different economic reports from 3 different universities, and man, people are sour out there. Carl wants to talk about supply-driven markets and demand-driven markets. He wants to talk about the difference. And I got to be honest, I don't know enough about where he's coming from to know what he's talking about. So I'm very anxious to get to this because, as I said, in a world of downtrodden ag thinkers, Carl Setzer thinks maybe things aren't quite as bad as they seem. We'll find out. After that, in the 4th segment today, I've got some fresh news on Chinese urea production. You're not going to want to miss that. We're going to talk fertilizer in the 4th segment. And directly after the news, we do have Matt Bennett from agmarket.net standing by for some perspective on these wacky markets today. So let's get to the news, where wheat futures were the upside leaders among the grain and oilseeds today, with the U.S. dollar under pressure. State-level winter wheat crop condition ratings released yesterday signaled more general improvement in the HRW crop over the past month. Ukrainian President Volodymyr Zelensky said that without new U.S. military aid, his country will be unable to defend a Black Sea shipping corridor. May SRW futures extended above the 10-day moving average of 577 1/4, now facing resistance at the 20-day moving average of 590 3/4. July HRW wheat futures gained 9 3/4 to 576 1/4. July SRW wheat was up 9 1/4 cents to 586 1/4. July spring wheat closed at 666 1/2. That's up 8 3/4 today. The Ukraine thing, man. New U.S. military aid. We've had Congress out on recess. I think they're all fully assembled as of today. Maybe it's tomorrow. The other half gets back. I'm not sure which half is back. Whatever. I can't keep track of it all. The thought is, we if we're going to hear something on funding for Ukraine, it needs to happen quick. Because it sounds like it's spiraling out of control quickly over there in Ukraine. They need some cash to keep things rolling. Corn futures extended yesterday's gains amid support of outside markets. South American crop consultant Dr. Michael Cordonnier kept his Brazilian and Argentine corn crop estimates unchanged while maintaining a neutral to lower bias toward both crops moving forward. Mexico's agricultural harvested area is projected to drop in 2024 due to drought, prompting another record corn import figure this year. Here at home, May corn failed to best resistance at the 10-day moving average of 427 1/2. Initial support lies at Monday's close of 422 1/2. May corn futures 2 cents higher today, 423 1/2. July corn futures gained 2 1/4 cents to 436. December corn futures added 3 cents to 4.60. Soybean futures posted follow-through gains after a solid overnight performance, but weakness in soybean meal dragged soybeans into negative territory. USDA did report daily export sales of 123,000 metric tons of beans for delivery to unknown destinations for the 23-24 marketing year. Dr. Michael Cordonier kept his Brazilian and Argentine soybean estimates unchanged, given rains last week and more in the forecast this week. Cordonier maintained a neutral to lower bias toward both the Argentine and Brazilian soybean crops. Here at home, May beans closed just below initial support at 11.43 and 1/4, indicating persistent bearish momentum. And actually, that May contract, we're going to call it 2.5 cents below support. It seems like support may have been broken yet again in the beans. We'll ask Carl about that. July cotton was 417 points higher today, up over 100 at 175. Brian Grady talked about that 100 level in the cotton this morning. Well, fat cattle futures were unable to muster a move higher in today's trade as technical selling limited the upside. USDA's cold storage report showed frozen beef stocks at the end of Jan down 4.9 million pounds from Dece. Beef stocks fell 11.2% from January 2023. 7.8% below the 5-year average. April live cattle softened 37.5 cents today to 187.72.5. June futures down 52.5 to 183.57.5, and April feeders gained a nickel to 258.95. And on the snout side, lean hog futures higher today, although strength was limited as traders refused to build in too much futures premium to the cash index. Cold storage report showed pork stocks rose during January. April hogs down 37.5 to 85.90. June hogs faltered 52.5 to close at 99.32.5. And with that, let's bring in agmarket.net's Matt Bennett. Mr. Bennett, welcome to AgriTalk. What do you like in these markets?
Well, it's nice to see a little bit of green on the screen finally. You kind of reversed there yesterday on the corn market. Little bit of fall through here today. I mean, up a penny or two, beats down 5-6 cents several days in a row.
That's
So,
right.
I mean, it certainly is nice to see. I mean, we're down here at Commodity Classic this week. We're going to try to talk about markets somewhat. I think that, I've been following a little bit with Jim Wiesmeyer and Pro Farmer and whatnot. I mean, this announcement this week on SAF could be a pretty darn big deal. So I think that as far as a longer term type of action, I think we need to pay close attention. Are we going to be able to see corn-based ethanol, participate in this with the tax credits and whatnot? But yeah, this week is a better week than last week so far. Let's not get ahead of ourselves though.
Well, and if I'm looking over at fat cattle, I mean, they tried earlier in the day. We at least had mixed. We wound up mixed in the feeders anyway.
Yeah, absolutely. This cattle market's had a heck of a run here after taking such a huge drop off. I think one last notable thing that I will tell you that I heard a little that I think could be playing into this corn thing is we're hearing about, some maybe some Chinese business off the P&W. It's rumors right now, but there certainly seems to be a little bit of a buildup in the lineup out there. So that would tell you that someone's in there maybe buying some corn. That would be a really nice thing, something that we sorely need.
Well, that would be, and well timed too. Maybe they're looking at this just little mini pop that we're getting here. It doesn't seem very scary, but maybe if I have one job and that's to get corn, I might want to get on it.
Absolutely. Hey, buddy, good talking to you.
Matt Bennett, agmarket.net. Appreciate you, brother.
Yep.
Okay, coming up next, we've got the commodities cowboy, Carl Setzer from Consus. We're going to talk some of the fundamentals. We're going to talk supply and demand balance. What is the difference between a supply-driven and a demand-driven market? Which one does Carl believe we're in? What should we... so many questions. AgriTalk. In the morning, you're coffeeed up and you're thinking. In the afternoon, you've calmed down, but you're still thinking. We're here all day. AgriTalk. And in fact, we're here right now. Well, me and the dog are here right now. So glad to have you along with us here on AgriTalk on your Tuesday. February's coming to an end. It almost feels like we were robbed of that horribly depressing ongoing February, doesn't it? Like it's usually so cold and you get to about the 20th and you think, wow, is it not summertime yet? Will it ever? Anyway, so here we are at the 27th of February and it feels great. 77 degrees here in Kansas City. And sunshiny. It's gorgeous. It does sound like we're going to have a little bit of a cool down, but then after that, right back to the upside on the temperatures. Let's all keep our fingers crossed for that. Okay, let's bring him in. Carl Setzer from Kansas. Carl, you're a great friend of the show. You've been with us since pretty much the beginning, brother. How are you today?
Doing fantastic today. How are you, Davis?
I'm sure glad to hear that. I'm very well, very well. Before we get too far into this conversation, you and I didn't talk about this ahead of time when we were comparing notes, but I got to know, and I'm pretty sure the listeners would like to know too, do you have any idea if miniature steers taste as good as the regular-sized ones? Can you report on that?
Oh, a lot less tenderizing.
Really?
I don't know, and I'm going to catch flack from that from within the office. We'll leave it at that. But
That's right.
that's my guess. That's my guess.
Okay.
They just seem tender. They seem like they'd be tender.
I would think so too. Yeah.
Prime rib, end to end.
Boy, that's a dream come true. That's a dream come true right there. Carl, there's an awful lot. I'm really glad to have you on here. You're a super pragmatic, reasonable, sensible, super smart guy. Not too much build up here. But you said something in our emails this morning that I really, really like, and I have to remind myself of this from time to time. And you said this: I think we need to stress not to panic. I want to give you a chance to speak broadly about that, and then maybe we can get into some more specifics. Go ahead. Why? I don't know. Panic seems easy, buddy.
It certainly does. And the thing is, Davis, the way I look at the market, I mean, let's be realistic here. $4, it's a lot harder to sell $4 corn than it is $6 corn on the board. It's a lot harder to sell 11 and 30 cent soybeans than it is to sell $14 soybeans. And we're starting to get loaded up. The funds are starting to get loaded up on the short side. There is no risk premium to speak of in this market. And now I'm not saying that we're just going to put in a V bottom and rally off that. I'm not saying that by any means. But you got to look at it, and pretty soon, all the bearish news that you can throw at a market has been thrown at it, and that is pretty close to where we're at right now. And that's why I'm telling guys, don't panic, don't beat yourself up too hard, because the market is giving signs that it's nearing a bottom. Now we could just hold at that bottom for weeks, months.
Mm-hmm.
But that's better than this continual bleeding that we've had to the downside. And this is especially in front of this spring planting season, and like I said, Davis, I'm not trying to get bullish, but boy, it is hard to get more bearish at this stage.
I'll give you that. Sure. Yeah. That makes a lot of sense. Are the acreage numbers something that could maybe give us a little nudge, or at least help us to place a floor a little bit if we get some more or fewer corn acres? I mean, are these the sorts of things you're talking about?
I think the acreage is something we definitely have to watch. I think, corn acres, might be a little strong with what came out of the forum. And of course, we're a month away from the USDA numbers, and those will be adjusted as well, obviously. But boy, on one hand, you want to look at it and say, we're probably going to lose corn acres. But then I look at the other side, and this is where I think we're starting to, maybe overlook this a little bit. You got to look at spring weather coming up at us. And, we've seen gradual improvement to our drought conditions, but there's still roughly a quarter of the United States, the Corn Belt, that's still in drought. And a lot of that area is in Iowa, and especially that eastern side of Iowa. That drought is hanging in there. We're sitting here looking at a market. It's starting to get a little bit dry out here. I'm not panicking, because if you're going to have a drought, spring is the best time to have a drought, because you can get that crop in fast. Yeah. But boy, if we don't get any rain after that, and it's hard to, I'm putting out some things that I'm definitely watching. With a 55% chance of shifting back to a La Nina this coming production season, I can't be bearish weather right now. I really can't. I can't be overly bullish, but boy, like I said, before, Davis, when we have no risk premium in this market, we're oversold and the funds are loaded up to the short side. It's just going to take one spark, and it's, last guy out, we shut the lights off for us.
Right. Or can we, that feels like it assumes something of a herd mentality among these shorts. One guy's out, they all go. They find that hole in the fence, and that's all she wrote. Now they're all over the neighborhood. Is that part of your thinking here?
It is, and over the past week or so here, we've seen the weak shorts get flushed out. We see, for example, today in soybeans, when we rallied, to me that was a perfect. We're getting some shorts out ahead of first notice day. I heard a month end. That's not surprising to get the weak ones out, but we need to see buying go all day long from bell to bell. And see these funds in there, and we just haven't got that momentum behind us yet. We just need that one spark. And I put out one example: weather. Like Matt said, if we see China come in and buy corn off the PNW, that would be a huge. I mean, this market is starved for something to trade fresh, and it isn't going to take much, and we're going to see things turn. That's my opinion on this one.
Well, I like that, and I would just reiterate what you were careful to point out at the beginning of this segment of the conversation, is that you're not predicting or even expecting, you're not hoping for this huge dramatic V bottom followed by a parabolic move back to 775, and everything's great. If right now we're mostly concerned, well, just stop the selling. Can we just stop the selling for now? We've talked about that as phase one here.
That's it. Just stop the bleeding. Let us regroup a little bit. Let the market work through what it's got, and then we start to grind higher. And these saucer bottoms, that is what I could see coming at us.
All right. Well, okay, but one of the main concerns is supply. I mean, if we're looking at carryout numbers, I mean, I think it could be argued we're in an oversupplied market and in danger of a supply sort of snowball, as Chip sometimes talks about. Let's get into that difference between a supply-driven and a demand-driven market. We may need to clean up our conversation and finish it up on the other side of the break, but Carl, I feel like this is vital to getting to where you're coming from.
Yeah, and I'll start by just dividing the two up, Davis, when you're in a supply-driven market, all talk is on the available bushels, and the available bushels are what's driving the market. Available cattle are what's driving futures, available hogs, what the available commodity is. When you have a demand-driven market, that means you have more buyers than sellers. That's basically how we can, you've got the demand. We have very, very good demand in our market right now. Corn demand from the 2022 to 23 marketing year to the 23-24, 849 million bushel increase in corn demand from year to year. Huge jump in corn demand. The thing is, that still leaves us with a 14.9% stocks to use, up 5 points from last year. We have huge demand for our corn, Davis. We just have that much corn to work through, and that huge supply is hanging over the market. And then let's throw in the South American crop going to be bigger. Global corn production going to be up, I believe, 22 million metric tons this year over last year on a whole. Then all of a sudden you take all the importers and they say, hey, we probably don't need to push as hard. We don't need to jump out. We don't need to line up 6 months worth of usage because we got this huge supply at us. We can go month to month. We can go mouth to mouth. We can do whatever we want. And that is where we're at with corn right now. We're even there a little bit on soybeans with this huge crop coming out of South America. I mean, we're going to have a big soybean crop out of South America this year. There is no way around that. Even in the United States, we got to look at our demand this year was cut 161 million bushels this marketing year from last, Davis. That only increased our carryout 51 million bushels. We still have a tight 7.6% stocks to use ratio. And quite honestly, I'm going to give everybody a secret here.
Uh-oh.
I really
Hold
don't.
Hold it. We got to go to a break. Cliffhanger on AgriTalk. Let's go to the markets page at profarmer.com and check today's closes. For July, hard red winter wheat futures gained 9 3/4 to 5.76 1/4. July SRW wheat up 9 1/4 cents to 5.86 1/4. May corn futures were 2 cents higher, 4.23 1/2. December corn futures added 3 cents to 4.60. May soybean futures were 4 1/2 cents lower, 11.40 3/4. July beans declined 3 3/4 cents to 11.51 1/2. July cotton 417 points higher at 175. On your livestocks, April fat cattle down 37 1/2 cents to 187.72 1/2. April feeders up a nickel, 258.95, and April lean hog futures down 37 1/2 to 85.90. Get more market news every single market day. Visit tryprofarmer.com. Opinions expressed on AgriTalk do not necessarily reflect the views of Farm Journal Broadcasting, affiliate stations, or sponsors. You're listening to AgriTalk, where the conversation begins. Join us at 855-4-TALK-AG. And welcome back to AgriTalk, everybody. Your pal Davis Michelson behind the big green leafy microphone of AgriTalk. I've got Carl Setzer from Consus with me today. We were talking about the differences between a supply-driven and a demand-driven market. We had made it over into the soybeans, and we cliffhanged you. Sorry about that, beloved listeners. It's fun. It's fun, right? It's a thing. Carl has one. He said he's got a secret. Carl, do you remember the secret?
Oh, absolutely, I do. Davis, I got to tell you, I mean, when these WASDE numbers come out every month, I know colleagues that sort through every single line and look at over and dwell on the numbers until the next report comes out. I am not that ambitious.
All right.
I go straight to the stocks to use. Yep. I really don't care what the other numbers tell me. You tell me what the stocks to use ratio is going to be, and if it's getting larger or smaller. That'll save you a lot of heartache going through these numbers. And there again, let's look at them. The stocks to use we mentioned on corn, we went from 9.9 to 14.9. It's a 5% jump in stocks to use. We are above a point where we need to be rationing. If we get around that 10, 11%, you tend to see price rationing develop. Soybeans, our stocks to use in the 2022-23 marketing year, 6.1%. This year, it's going to increase to 7.6%. 7% is usually where we see some price rationing take place. Wheat, we're going from 30 to 35. So our stocks to use have all increased from last year to this year. So to see price pressure, really not that surprising. It's how much price pressure you see. And where we've seen the most of that is because the global stocks to use, corn and soybeans, are getting loose, just like the United States is. We're starting to get a little bit more production, a little bit more supply in there. The global wheat supply expected to tighten a little bit. Now let's look at where the funds are positioned. Pretty close to record short positions in corn and soybeans. They're short wheat, but only about 75,000 contracts or so. Funds are not real heavy to sell this wheat complex. And you look at that global stocks to use, that is where I get a little bit of optimism underneath this wheat market, because we're just not seeing that managed money selling in that complex like we have in the corn and soybeans. But even so, we're not that far removed. We get one hiccup in production that maybe a developing La Nina this spring or summer could bring to Argentina like it did 2 years ago, and we're going to see this market flip.
That's really interesting. Now, I guess my concern is, of course, through all that, we still need to grow a crop. Are you still up in Michigan? I'm not sure where you are geographically anymore, Carl.
I am in Lansing, Michigan. Yes,
Lansing,
sir.
Michigan. So what was the snow cover like up there? I'm concerned there wasn't enough snow to really recharge us to the degree that we need to. You already said it's dry around here in some key areas.
I pushed snow once this winter, and basically that's because I wanted to get out of the house for a day. Seriously, we have not had. Yeah, we've had some rains. And as a matter of fact, we're supposed to get storms. This system coming through tonight is supposed to give us some rain.
That's right.
But, knock on wood, the horse pasture and the neighbors' cattle lots, we're dry. Matter of fact, the neighbors across the road cleaned out their cattle pens and already worked the ground. We are dry, and we have no frost out here.
Now, there is the argument that modern seed genetics are up to the task here. And in that respect, maybe droughts get a little bit less scary as we go on, but we'd still sure like to see a little soil moisture. Let's just talk about marketing really quickly on corn and soybeans. So given all of this, perhaps there is a saucer bottom. How do we market in corn and soybeans for what you're describing here?
I look at these markets, and like I said, I do feel that we're getting towards, without a huge black swan event, and that's what we have staring at us in these markets right now. What the unknown is, especially with the geopolitical developments taking place. I'm advising my guys, look, sell what you need to, don't dump your entire production.
Okay.
But if you need to generate cash flow, peel off some bushels. I mean, I hate to see a guy come in here and looking at, March futures at 408. Let's go out to the summer, 436. It's all relative. But the thing is you still to market some bushels at these values. And then make some target orders. If we rally 5 cents, market another small percentage or however you want, but get a plan in place, because look at the way this market has been. We've seen gains in the overnight session that we haven't during day trade.
Right.
There's opportunity, but you got to be prepared for it. And then, let's not fall asleep on those new crop values out there. D's 24 corn at 460.
Sure.
Soybeans sitting out there, 1130, pretty much the same as where we are right now. But the thing is, I think the market is gonna rally, but if we don't, we need to have a plan in place, and that's where I'm saying we need to peel off some bushels, especially if you need to generate some cash flow.
Yeah, just make a little breathing room. If we're not careful, we're going to run out of time without talking about livestock. Ongoing liquidation in China's hog herd. What do you make of it?
That's something that I think we need to look at, because we have a twofold reaction we could see here in the United States. That January hog slaughter came in at 37.25 million head in China, up 29% from a year ago. Now that put a lot of pork on their supply line ahead of the Lunar New Year. We've seen some of these numbers indicating maybe red meat demand was a little bit higher during the Lunar New Year than what was forecast. And China has been a steady buyer of beef and pork from us. I think China might be going through some consolidation in their hog herd, but they still want to make some imports from the United States. On the one hand, I think we could see more beef and pork sold. But the feed grain exports, the soy meal, if we see this contraction in China's, their sow herd was down to 40.6 million head at the end of January. That was down 7% from last January. If we continue to see this contraction, we might see less feed grain demand going into China, but we could see more red meat demand. And that's actually better for the U.S. farmer, because we can all take part in that process.
Yeah, absolutely. Cattle numbers still look to be a problem. No signs of expansion yet. You mentioned the brownification of the pastures up there in Michigan. Others are not immune to the brownification as well. The beef supply, the cattle supply. Let's go there.
cattle supply is tight. We know it's tight, but looking at it, the old saying is, Davis, you feed $6 corn with a teaspoon and $4 corn with a scoop shovel.
Right.
And, guys they're holding these animals a little bit longer. We're seeing steers hang in there a little bit longer. Some of these weekly, the carcass weights, if you follow them, which I watch them pretty closely, we've seen them up 5, 6, 7 pounds from a year ago. You can have less numbers, but still generate a lot of beef when you look at it that way. And with the consumer demand being just a tad bit concerning heading into the grilling season, I'm not trying to get overly optimistic on livestock and especially on cattle. But boy, our red meat demand has not slowed at all. You go into the retail side of it, and people have no problem paying these prices for beef going into the summer, and we're not even to the heat of the grilling season yet.
Right.
To me, that is a good outlook. I think cattle futures hang in here for a while, especially with cheap feed grains and these declining numbers we've seen. And, our total red meat supply, you saw the numbers. We were down from where we were last year at this time. It's going to take a little bit of building to get that back up. And we are importing a lot of beef, but it's that, that select grade for hamburger. I tell you, we're sitting pretty good. I'm not too worried about livestock right now.
Okay. To wrap up here, Carl, we may be going over some territory we covered earlier here, but I want you to put a lid on this conversation. The outlook for grain farmers, not so good right now, but you're saying that there's no reason to panic at this point.
Yeah, I'm not panicking by any means, and yeah, it's depressing to look at, and I get that, but boy, you got to look at where you are, and like I said, it's going to take one small hiccup, and we could see this market, firm up,
so
quite quickly. Watch that South American production next year. If we see a return to a La Nina, and it's even remotely as strong as the last one, look, that cut out Argentina's production by 50%. Yeah. We can't rule that out happening this year because they are still rebuilding their soil moistures from that drought that they had.
Carl, I'm going to have to cut you loose there. Dude, wow. What a great talk. Lots to think through. Carl Setzer from Kansas. I appreciate you being here, buddy. When we come back, we're going to talk fertilizer, the weather, and then we'll be done for the day. I know. Such sweet sorrow on AgriTalk. On your favorite radio station or your preferred digital device, AgriTalk is live every weekday. Now, this is one of those songs you could sing at any age of life. In fact, I owe neither if Chip and Joe are listening wherever they may be. Hey, fellas! Travel safely. We're thinking about you. Looking forward to hear what they come up with down at Commodity Classic. The rest of this, after this show, the rest of it is all wall-to-wall Commodity Classic. It's going to be awesome. Tomorrow's afternoon show will be in the NCGA booth. That's up on the third floor, booth number 7405. And then we'll get into more later as the week progresses here. But that's where you can catch them doing AgriTalk live tomorrow afternoon, NCGA booth 7405 on the third floor. Great conversation with Carl Setzer there. That was a really, really refreshing perspective. A lot of gloom and doom out there. Just let's not panic. Let's keep our heads about us. I think it's a great message that he had. If you're just joining us right now, you got to go back and listen. Bro, he was really good. I have some news here that we didn't get to this morning. I want to talk about fertilizer prices. I got new prices. Well, they were out last week, but these are the latest that we have. And in fact, shameless plug for the Landowner newsletter. I'm just finishing it up, and each month I do a month-on-month analysis of fertilizer prices. But I'll give you the most recent ones here that we found because it's interesting. You know what? I'm going to kick it off with this news story from Ag Resource. It wound up in my email this morning. This from Ag Resource. Chinese urea production rates soar on low-cost coal. There's so much we could talk about just in there. You say the word coal. Don't get me started. Anyway, from Ag Resource, quote, profitable production economics are supporting China's highest urea operating rates in over a decade, as well as its rapidly growing fertilizer stockpile. China is the marginal urea supplier and normally exports when prices exceed the cost of production, which Ag Resource estimates at $225 a metric ton. That'll be a wholesale value. They continue. A revival in Chinese urea operating rates in the first quarter of this year offers hope to those seeking low-cost tons in the second quarter, when we believe the government's export ban will likely end. That's China's export ban of urea. They did that to try to promote local. Geez, they did that to encourage domestic production. Yeah, that's what I was trying to say. But it's about to end. It's coming to an end. The article continues and finishes with this. China's main consumption period is in late of the first quarter, so that's kind of nowish. And the producer normally returns to the global market afterward. When it exports, prices fall. We've seen China pull back from urea exports. Early in my career, 7, 8, 9, 10 years ago, over at Pro Farmer, chasing down the inputs and trying to figure out what is the deal with nitrogen? What are the price movers? What is it? What do I need to know about Chinese urea? Was the one. They were the leader in global exports. Oftentimes a benchmark price setter, and then off the market they go. And here we are. If we could get some urea back into this market out of China, it may help to not necessarily press down U.S. prices as much as just help global supply. Josh Linville of StoneX is always good to point out that sometimes things happen in the other side of the world that don't directly affect us here in the field, but they can impact the overall global situation, and maybe some supplies get rerouted from here to there, yada, yada, yada. More fertilizer in the world is a good thing. I think we can all agree on that. How much does it cost? Let's go to the Illinois Cost of Production Report. This from USDA last week, the 22nd of February, George Washington Davis Day. I've got anhydrous ammonia now. This is just for Illinois. Just for Illinois, I've got anhydrous ammonia down during the reporting period, 45 cents lower. That's on a range of $7.30 to $8.65 per short ton on anhydrous ammonia. The Illinois average down 45 cents at $784.55. Let me pop over to Iowa too, which is a separate report. Their offer is actually up $18 to $755.60. That's an average. But the high and the low end of this range, it's a lot narrower range, $725 to $775 in Iowa, to give us an average anhydrous print of $755.60. Back over to Illinois, reminder, $730 to $865 was our range there for an average of $784.55. Let's just buzz through these. We'll stay in Illinois. This is Illinois urea, up $7.20 to $533.60. UAN 28% up $1.88, $376.10. DAP, diammonium phosphate, unchanged, dead steady at $741.89. MAP is up. MAP is actually down $14.33 to $765.67. Phosphates are an area of concern. Overpriced. You know, we talk about that UAN 28% at $376.10. Call it $375 with $380 anhydrous. That feels about right for 28%. Your potash down a whole 25 cents to $519.33 in Illinois. Farm diesel up 16 cents to an Illinois average of $3.27. That's on a range from $3 to $3.49 per gallon. We got to get over to Iowa quickly. Once again, anhydrous is up $18, but still at $755.60 in Iowa. Urea down $11 to $578.25. They didn't report 28%. They usually don't on this report for some reason. We got 32%. That's up $3.75, $382.25. Basically priced in line where I like to see it with anhydrous ammonia in Iowa there. DAP, we're at $783.33. MAP is down about $8.50 to $828.80. And your potash is at $538.50 in Iowa. That's down $11.70. But look out for farm diesel. We're up 30 cents in Iowa to $3.25 per gallon. And propane, liquid propane gas, up 3 cents per gallon to $1.61. I will have the monthly plus some charts, a huge, awesome analysis page in Landowner Newsletter. Subscribers, it's coming just a couple more days. I'm putting the lid on it today. Let's talk about the weather. You want to? National Weather Service 6 to 10 day temperature outlook. Below normal temperatures from the western coast of Nebraska over to the Pacific Ocean. Above normal temperatures expected areas east of there. 6 to 10 day precipitation outlook. Basically near normal in Idaho and above normal every place else. Get out to the 7 to 14 day, March 6 to March 12. Basically the same setup. Cold out west, above normal temperatures remain out east. Still no Speedo weather in Alaska, by the way. Below normal precip comes into the Dakotas, otherwise above normal temperatures from that. So thanks, huge thanks to Carl Setzer from Kansas, Matt Bennett from Matt Bennett for joining us this morning. I'm your host, Davis Michelson on AgriTalk. Have a great day, everybody.